So just listen, you've got a lot less grey hair than someone like I have. You're a young guy. You are well skilled in your field. And obviously you would socialize in these type of circles, whether it be through business or sort of the groups of individuals that you socialize with now. What are the younger investors wanting? What sort of behaviors are they exhibiting around their investment choices they're making?
I definitely think there's a massive change in terms of what the younger investor wants versus your older crowd of people. I think there's a big shift in terms of investing in mining versus investing in a beehive type of thing. And what does it do to the environment? I do believe that the younger investors got a bigger interest in the impact that it has on the environment and those shares that you're looking at. Along with the fact that I think younger individuals are starting to look at investing as a whole, or even savings as a whole, a lot sooner than older generations. I think a lot of the times, your younger generations, they hit their 20s and they start to look at quite seriously what are they investing in, what do they want to do, and a big part of it is definitely the ESG impact, green feel to it, but also the idea of pretty much educating themselves before going to a financial advisor. So I think there's a big role in terms of individuals going to get their own knowledge, especially because knowledge is so accessible to us now, and then looking into the ideas of how do we like make alternatives more accessible to younger people, to individuals that aren't just ultra high net worth clients.
It's almost a trend where we're seeing, so the savings culture is still very strong, if not potentially even stronger than it was when I was in my 20s, potentially. But it's what the younger investors are looking for are investment vehicles or options that provide a little bit more sort of tangibility, potentially. They like to feel things. Maybe some of the traditional investment vehicles are a little bit intangible. However, it's quite an interesting trend as well, in the sense that you have that, and I'm seeing that as well now with the young investors. Then you jump over to the cryptos and blockchains, which is totally intangible, but it's got this huge support around it. So it is quite a tough one. But what I'm hearing is that the savings culture is strong, and if anything, I suppose COVID has taught us that saving is key, and having accessible funding and savings when they don't term it a black swan event now, where these unexpected events occur in the financial services industry. Yeah.
Exactly like you said, and that's why I gave you a little bit of a smile, is it's quite weird. The younger investors definitely looking for something more tangible. And I don't want to say that they've got control, but they've almost got a little bit more understanding of how does that work. And I think that's your impact side of things. But exactly like you said, on the extreme side of things, they've got like DeFi, your decentralized finance, and what does that look like? And they like the idea of that. You almost want to put it down to the fact that there's regulation that they don't enjoy. And that's what those two different areas have in common, is there's a lot less regulation. But to your point, I think with regards to savings, it's quite interesting. I think maybe my view is a little bit skewed in terms of savings, because I would almost like to say, although a large majority of people probably lost their jobs and had to pay cuts and those kinds of things during COVID, but I think a lot of people realized how important savings was, as well as the fact that like we should be saving during those periods. So where we were going nowhere, where we had hard lockdowns, whatever you were spending on fuel should have been saved. And I think from that perspective, there was a big push to say, hey, savings is important.
Certainly is. So I mean, I think we can both agree that the complexity of the financial services industry is more complex than ever. But what I've found, and you could probably ratify it, is that your younger investors, when they approach a financial institution like a Fedgroup, they are as you said there, they've done their homework. They're a little bit more prepared than your typical more mature investor, where they're often much happier to throw their full trust and reliance into their financial institution now. I mean, I've certainly found that in conversations with younger investors. They know exactly what they're talking about at the commencement of the conversation. Yeah. They, however, still like it's. I'm often met with the question, but the young investors want to do it all themselves. They do, but they also don't, because they understand that they need to partner with solid institutions and solid financial services companies that know what they're doing, because they have a different attribution to the value of time. For them, I found that they spend their time differently, and to spend their time administering their investments is just not what they want to do. They're happy to understand it. They won't just blindly go into something. They understand things a lot better. They get a lot of social buy-in. They do what I call wide consultation. Speak to friends, family, colleagues, etc. But once they're bought in, they're all in and they go for it. And I think we've seen that a lot of that with our impact farming platform, where we have a growing number of supporters. But after someone purchases their first beehive or lettuce stack, and they can see the rewards and see the integrity of the impact farming platform, a lot more sort of contribution, and they invest a lot more because they've bought into it, they've gained the trust, and it's obviously it's making that alternative space far more accessible for them now. Yeah. They like it, wrapped with all the great ESG, call it, elements of it now.
Exactly that. I think because information is so much more accessible, they want to know a little bit more prior to them engaging with anyone else. It's almost like I'm stuck to say that they're more trusting, but also less trusting. So they like the idea of, like you said, a wide consultation, asking older, asking younger, asking friends in different areas or different industries to then better understand what are they actually going to invest in before they speak to a financial advisor. Whereas I would, exactly like you said, I would think your older generation is very trusting of a single person saying something to you, very hidden with what they're doing with their finances.
What's interesting is that when we talk about balanced portfolios, when a balanced portfolio, it's almost along the lines of thinking about a diet, having a balanced diet. It all starts, actually, it emanates from you don't just arrive at having a balanced portfolio. Sure. It's a result of a process that you would work through in assessing one's risk, one's tolerance for risk, and one's ability to take risk. Those two very important factors. And then also importantly, planning for future liability events, what I call asset liability matching. So if you just take that analogy around a diet, a balanced diet is important. And we think about concepts of everything in moderation, etc., etc. But if you just directly relate it to that, now, not everyone has the same ability to cope with certain diets, and also have people with different tolerances to certain balanced diets. But in general, if you think about a balanced portfolio, as we said earlier, that is a portfolio that generally, very high level, has a 60% weighting towards your equity or stock market and a 40% weighting to alternative investment asset classes such as private equity, alternatives at the core, cash, bonds, property, etc. The risk process that you would run through will determine whether a balanced portfolio is suited for what you're trying to achieve. When you talk about that, you're talking very much around your strategic goals around investing. What a balanced portfolio does is generally smooth the journey. Okay? It doesn't totally obliterate any big dips in your portfolio, losing a bit of money or being below the market and above the market. Just like a balanced diet. A balanced diet is one way to get to your weight goal or your health goal or your BMI goal over a period in time. It's not saying that having a tactical strategy in investing in certain sectors of the economy or certain sectors or certain asset classes at a point in time tactically isn't right. So, such as all these interesting diets, if you look at all the different diets that are available and have prescription at the moment now. They are there, and people will prescribe to them at a certain point in time now to achieve a certain short-term goal. But over the long term, a balanced portfolio smooths the journey. So you can go into a specific diet, for instance, and get a massive weight loss or massive health benefits in a short period in time now. The sustainability of that decision is where you need to decide, is that for me, isn't that for me? So generally, the risk appetite and your tolerance to take risk, or your ability to take risk, determine whether a balanced portfolio over the long term is right, or if you need to employ some tactical asset allocations or tactical portfolio allocations now to achieve your investment goals.
Paul, I totally agree with you, but I think to your point, and maybe more of a question, would you almost say, I mean, ultimately, if you're using the diet analogy, you're ultimately always going to come back to everything in moderation. Yeah. So I think if we had a look at your alternative side of things, you're going to do an extreme diet to get short-term outcome, and then go back into your moderation. Would you say that's how you would constantly achieve that balanced portfolio?
Absolutely. And when you have those focused and tactical dieting strategies, it's important that you take those short-term gains and you protect them. So I see it so often where investors will overdo a tactical strategy, so they'll go and decide to invest in a certain asset class that'll give them some uplift in their portfolio performance now, but they don't lock in their gains soon enough. They will then take it too far, and that's just a bit of human nature as well.
Trying to ride the wave a little
Absolutely. It's, we littered with cognitive biases around how we invest and what emotional, mental forces are at play around how we invest, very much like diets. But it's so important to know to work with a financial advisor and work with an investment professional when you're wanting to map out this process now, so that someone can journey with you and partner with you and say, okay, enough is enough now. You've achieved what we've achieved as a partnership, or you've achieved what you needed to achieve. Now let's go back to our long-term strategy and lock in those goals and sustain them. Almost preserve your gains that you've made, like you would with a diet. Preserve the benefits you've achieved for the short-term gains. I just genuinely believe, and that's why a balanced diet is a good analogy for a balanced investment portfolio, is that if you employ extremities too often for too long, it ultimately can hurt you.
Yeah, so I think I totally agree with you. If you look at the diet, like, you'll have a lot of volatility. Yeah. I think at the end of the day, you would have your spikes, your highs, your lows, just like a balanced portfolio. But I think, Paul, like something that you mentioned there, and I think that's how you would build your balanced portfolio, is off of your risk appetite.
Absolutely.
How does that, like, if I'm new to investing, or if I'm trying to get into it, I constantly sit back and go, oh, I'm quite a wild person. I think my risk appetite's quite high. How do I really know what that looks like?
Absolutely. So that's one of the fundamentals. So we spoke very much around younger investors and some of the behaviors they're exhibiting versus your more mature, older investors. Yeah. And we'll talk a bit about that just now. But in essence, all investment decisions and portfolio decisions boil down to should boil down to a systematic process. And that's where it's so important to partner with the likes of a Fedgroup or a professional organization or your financial advisor to actually map out that process for you to get to the right decision. Now, I always say one of the most important aspects for an investor in their investing journey is to take the emotion out of investing. And that's why it's so important to employ a systematic process to make those decisions. It starts at risk profiling. And as I mentioned, risk profiling or assessing what your risk profile is now, everyone has their different philosophies. I believe it boils down to two core principles: your ability to take risk and your tolerance of risk. So that's, you spoke about someone saying, no, I'm a risky type of person. Just the fact that you like to go bungee jumping and jump out of planes on weekends is definitely an important factor around your tolerance of risk. But when it comes to your ability to take risk, that might be a very different picture altogether. The combination of the two is an important one. So in essence, someone go through a risk profile process. Only from there will you understand your effectively your risk appetite or your risk profile. That's when you actually then would employ the second part of your process. Say, okay, now we need to employ the building blocks. Very much around, think I'm also Lego set now. Right, we understand our risk profile, we want to build X. Now what blocks do we use now? We talk about the building blocks being your asset classes. So what bonds, what equities, what alternatives, what property, etc., assets do we need to employ to build and to match this portfolio to your risk profile? And once we've decided that, then you then go down to the point around with who? Okay? Do we go, okay, we know we need to give you exposure for your strategy. 10% needs to be in alternatives. Who do we go and partner with? Do we go and partner with Fedgroup, etc., to bring alive that basically asset allocation or that portfolio construction process now?
Thanks, Paul. I just wanted to ask, with regards to your ability to take risk, what is that broken down into? How do you, is that off the market, or is that as an individual, or how would you break that down?
So your ability to take risk is something that's where we take the emotion out of it now. We assess an individual based on their available cash flow, the liabilities that they need to meet in life. Talking about liabilities, that might be, in 2 years' time, you are budgeting to, say, for instance, you have a daughter and she's going to be getting her driver's license now, and you want her to buy her a car in 3 years' time. Now that is your ability to take risk. Now that's where
you're not jumping into crypto then.
Exactly, absolutely. So if you've got 3 years, you're certainly not going to be allocating. Your ability to take risk there is low, because you need to make sure that you have the rand amount to buy your daughter her car in 3 years' time now. That actually then we call that asset liability matching, and that's an important aspect around the ability to take one's risk. And your ability is cemented in very much your actual financial affairs, which a lot of people ignore through the investment process now, which is a part of a cognitive bias process now, which we all are party to, and that's ultimately the non-emotional side of your risk profiling.
And I think, Paul, you made a great point in the sense where a lot of people, like I said to you, you're wild, you want the returns, like especially when you're starting out, you're thinking, oh, what is 6%, what is 7%? That doesn't sound like a lot. So you start to think that you're very risk tolerant or risk seeking. And I think, to your point, like you said, you've got to come back to what is your ability, what are your liabilities that you need. And I think that varies at different stages. But I think, if you had a look at an investor that's starting out, and let's give him a profile so it's a little bit easier, but let's say he's 20 years old now, he's now getting out of varsity, or he's busy with varsity and he wants to start looking to the future. What would his tips be? What would you say to him to start looking at?
Start looking, absolutely. So the first thing is, because you are a young investor, you've got a lot of time on your hands. Okay, so you have time to make mistakes. That is so important, because you have to get comfortable with the people you work with around your investments, as well as what investments work for you. So the first bit of advice is to partner with someone in the process. Now, partner with a professional. A lot of younger investors are almost sometimes embarrassed because they don't have a lot of money to invest or to save. That's not the point. The point is, it's incredibly admirable to, at a young age, to make the conscious decision to save. Okay, that's the first very, very important fact now. If you are making that decision in your early 20s to save, you're already ahead of everyone in past generations as well. The second thing is, so don't go it alone. Partner with a professional organization now that appeals to you, and have conversations with these organizations now. Have conversations and see where you fit culturally and where you don't. That's very, very important, because ultimately a lot of this still involves dealing with people and amongst all the tech that drives investments. That's the first thing. The second thing is experiment a bit now. So don't put everything into one basket. Okay, you've heard that old saying.
Don't put your eggs all in one basket.
Right, don't put your eggs in. That is incredibly important. Now, that's a very generalist statement. Now, sometimes you have to put your eggs in one basket to achieve a certain investment goal, and that's fine as long as it's well thought out. But when you're young, certainly spread it out. Understand. Go and put some money into impact farming and understand how it works. Put some money into a traditional unit trust and understand what feels comfortable, what doesn't, etc. Even if you can, go and purchase some property. If you can, if you have the ability to even raise some debt and actually buy your first property now. It's an interesting behavior at the moment I'm finding is less and less young investors are investing in direct property at the moment now. They're choosing to rather rent their primary residences, but on the flip side are also then, however, investing in property as a pure definition. What is an investment? Investment is something that grows in value as well as generates an income. So, they say they're far more prudent around their property investments being, it's less around, it's the home I live in I need to own. It's more around, I need to invest in property as a way to grow my wealth and preserve my wealth over time now. So property is still very much a firm basis there. So in essence, partner with professionals. Don't take yourself too seriously too soon, and experiment a bit and see what you like and what you don't like and what makes you feel right. Because ultimately, this is still around your investment, your money, your wealth, and your journey and your story that you're telling one day when you have saved and you leave money for your heirs or for family, or you donate money. It's really nice to understand that it's been a story to tell around what drove you. And a lot of people will ask you if you've been a good investor or a good saver. Why did you do it? How did you do it? What's your story? And it's so important to actually have that story. So experiment a bit and have some fun.